radio for a really great future. We're talking real money.
Let's make one thing perfectly clear from the very beginning of this podcast. We are not attempting to scare the living daylights out of you. This is not a veiled attempt to make you afraid of investing. We don't want that. We want you to believe in investing. However, there are times, and we're not timing. Oh, gosh, I hate this. I don't know how to get into this. There are times when you can look around and go, there's stuff going on right now that feels a lot like fill in the blank, 2007, fill in the blank, 1999, fill in the blank, 1986, fill in the blank, 1973, fill in the blank, 1929. No. And are we in one of those times that kind of feels like those predecessors to market design, I don't want to say crashes because that sounds too scary. Market declines. Let's just use that, shall we? Hi, everybody. Welcome to Talking Real Money. Don McDonald. That's me. Over there. Look at that. Right there in the pink shirt. Thomas Charles Koch Jr. I'm just going to call him Junior. Hey, Junior. Welcome to the show.
Most appropriate, I got to say. So this comes to mind again, and this is a recurring topic because we see many of you, and you write us. You're like, well, what about this fund? What about that fund? I think I should be part of that. And so this is a fascinating piece that was written this week by a guy named Andrew Ross Sorkin, who is, you may have seen him on CNBC Squawk Box. He writes for the New York Times. He wrote the book Too Big to Fail, which I did like, about the 2008 crisis. But and he's got a brand new book called The 1929 Inside the Greatest Crash in Wall Street History and How It Shattered a Nation, which I've added to my Kindle reader. So I'll be taking that up soon. I'm looking forward to it. I like his writing. But speaking of writing, he wrote a tome on this topic of should we compare today, as you just did, Don, to, I hate to say it, 1929, because that really gets people freaked out when you say 1929.
That was the market crash of all market crashes. That was the big one. Oh, and by the way, just interject here. He's also the co-creator of the television show Billions.
I couldn't find that anywhere, but I'll take your word for that.
No, he is.
Because there is another Sorkin in no relation who is a TV guy.
No. Andrew Ross did Billions. You're thinking of Aaron Sorkin,
yes,
who did The West Wing.
West Wing, which I adore.
Two different guys. But Andrew Ross Sorkin, that he was the guy behind Billions.
Okay, I'll take
the
your
show
word for
we
it.
both enjoyed. I mean,
yes,
you even bought their merch.
I did buy their merch, which I used to wear around, and I only think two people ever said, hey, that's from, yeah, it is. Here's what he writes. This is a great warning to anybody who is trying to go for a shortcut to investing, which is what I think a lot of people are doing right now. That's the word I would use. He says we're in the grip of a sweeping new age of financialization and innovation, the broadest transformation in money and investing since the 1920s. Private equity, venture capital, private credit are now about to be repackaged for the masses and even woven into 401k retirement plans. Crypto tokens are being sold as a way to buy slices of private firms like SpaceX and OpenAI in the gray zone of securities law. And this is the part, it's not even the fact that these are now being offered to people that worries him. Mm-hmm. It's the fact that the rules are being loosened. In his words, a new administration in Washington is determined to loosen the rules, creating a permissive spirit similar to the one that passed for innovation in the 1920s. Then we can go through some of these examples, which frankly, when you put them all together, are kind of frightening.
Well, and I think that's the biggest takeaway from all this. The message that you should take is that these kinds of products, Wall Street's always trying to bring something out that confounds, confuses, bewilders investors to make it easier to sell it. You know, it sounds too good to be true, and really, would they lie? The problem is the decline in protection and regulation, which puts the onus on one person. That's you.
Yeah,
You've got to vet your own investments.
Makes me extremely nervous when people like Vlad Tenev of Robinhood says the next frontier is making sure these opportunities are open to retail investors. But let's just take a look at the bigger picture here.
His name is Vlad.
Vlad Tenev of Robinhood.
Vlad the Impaler.
Yeah, exactly. So he points out that only 40% of Americans don't own any stock, and 90% of all equities are controlled by the wealthiest 10% of families. And always the goal of Wall Street is that let's get more of those people to give us their money, because there's a lot of money out there that we could take advantage of. And some of the deals that were only offered to accredited investors, which that's a person who has to have $200,000 a year of income. I think it's $1 million of net worth outside of your home. Those people were allowed into these things, the private market, but now those barriers are steadily being lowered. In his words, when transformation comes this quickly, it rarely benefits everyone unless it's paired with transparency, oversight, and regulation. So he walks through a few of these examples, Don. We've talked about cryptocurrencies, but we really haven't spent that much time on the company's strategy, which he gets into, and the fact that they're basically a Bitcoin company now, right? They're buying
MicroStrategy now. Strategy, yeah.
Now strategy.
We're not talking about a strategy. It's a company called Strategy.
Exactly.
Michael Saylor's company that used to actually make things. They made software. Now they do nothing but buy Bitcoin.
Yeah, it's just weird. He also points out some Bitcoin exchange-traded funds now borrow against their holdings and use that leverage to promise 2 or 3 times the coin's daily moves. That is not investing. That is speculating and gambling. You have to say it. There's no other way around it, right? I mean,
it's pure gambling.
Yeah.
And I want to go back to something you mentioned and the article mentioned, and that is Vlad the Impaler saying, well, there's still 40% who don't own stocks. Dude. That's about as low as it probably can get, because the 40% are people who probably could never afford to own stocks. Think about this for a minute, if you want to put things in perspective. That big crash you were mentioning, what was that, 1929?
Yes.
In 1929, less than 3% of the U.S. population owned stocks.
Wow. Small
And
number.
we had a crash of that magnitude. Less than 3%.
And it caused a lot of people to give up on stocks, by the way, including one of my grandfathers, who just said, I will never do that again. He had money as a young man. He goes through some more examples. Sorry?
He must have been a rich person if he was among the 2 to 3% that owned stocks.
Semi-famous, as you know. Somebody's writing a book about him now. But BlackRock has launched their ETF, their Bitcoin ETF, ProShares, as ETFs that use borrowing and derivatives to deliver 2 times Bitcoin's daily gains or losses. He compares it to an interesting example from way, way back in 1929, the Goldman Sachs Investment Trust, where they had a trust that invested in, guess what, other trusts. Then they used leverage. He calls it a Russian doll of debt. At its peak, the shares were 300. By 1932, those same shares that were once $300 per were less than 2. It's scary how things can go down
this is the downside of leverage that isn't pitched to you in that excitement pitch that they give. That's hey, we can make you so much money. Look, when this is rising, we're making a ton of money. You forget that when it falls, your losses are bigger and more dramatic and can happen in seconds instead of years.
And that's one thing we've seen. We saw that recently on a Friday when the market went down a lot, and a lot of those went bang, that got hammered. But then there's also this aspect of private company investments. You mentioned Vlad the Impaler. He wants to build products that allow everyday investors to buy into private companies. They've been experimenting with private company tokens. He calls this leveling the playing field. I call it taking risk you don't need to take. They filed paperwork to create a new financial instrument which would package shares of private companies into a fund that would allow people to invest in it, would be sidestepping the disclosure, auditing, and quarterly reporting that companies face as publicly traded companies, right? And they want to move this stuff into your retirement plan.
Well, and here's the thing about these private companies. The biggest problem with private equity is valuing it. What's it worth? Well, they'll tell you it's worth this based on their own internal assessments, but that's not what it's really worth. I think my house is really, if it's worth $2.5 million easy. Even though right now in the market, no one would probably give me more than 1.1. I think it's worth more. So I'm going to private equitize it and say, hey, buy my house for $2 million because that's what I say it's worth.
Yeah, and he points this out, that when a non-public company says it's worth $10 billion, that's because a small number of venture capitalists or private equity executives have decided that's what it's worth. He calls it the mark to make believe. Not the mark
Instead
to market.
Instead of marking to the market, mark
exactly.
to the make-believe.
It's really good. And these are headed to your 401k, which Wall Street is salivating over, according to him, $9 trillion in those 401ks that they want to get their hands on and all that kind of good stuff. So, and by the way, he makes a very good point here. Beyond the valuation, Don, that you said, when it comes to that point when in your life when you may need to cash out, it may be hard to get your money because some of these companies aren't going to be able to create the cash to pay for your shares, correct?
Right, because it's a made-up market. There's got to be, for any asset, there has to be both a buyer and a seller. So if you're selling, good luck getting your money if there are no buyers. If there's nobody willing to pay what you think it's worth. This is Wall Street. It just in a nutshell. This epitomizes it to such a high degree, which is why I like Andrew Ross Sorkin. As a matter of fact, I really enjoyed Billions. I think up until the end, it kind of was doing a little shark jumping later.
Yeah, it did at the end.
But the first couple of seasons, if you want to get a feel for the evil that is the highest end of Wall Street, you should watch some of at least first couple of seasons of Billions.
According to Sorkin, every great panic in modern finance has started the same way. Too much borrowed money. In 1929, it was margin loans, right? In 2008, it was subprime mortgages. And he points out in the 1930s that 9,000 banks failed. In 2008, the federal government let about 300 fail, including the largest trust bank right here in Seattle called Washington Mutual. So where is the leverage now, he says? Well, it's moved from banks to this new market called private credit, which was once a boutique strategy in his mind. It's now $2 trillion that people are looking to hand off to you, and with the promise of course, higher yields than public bond markets, right? Which makes sense. You're taking more risk. You should get more reward.
Hey, if you're getting 9, 10, 11%, and they say it's with the same amount of risk as bonds, well, you'd be a fool not to take that. Problem is, and we have to really change many of us have to change our mindsets. There's too high a degree of trust in what we believe are authorities. People, I know this is going to come as a shock to you. So everybody sit down. Hold on to the arms of your chair. Ready? Let me let you in on something. People lie. They do. They lie. They don't tell the truth sometimes. Have you noticed that ever happening in your life? I know you live in a perfect world. You've got your little bubble and no one does. But these guys lie. These gals lie a lot. I'm sorry, but they do. It's a fact.
And so the question then becomes, how do you protect yourself? Well, for me, part one is, and we're all guilty of this to some degree, because you and I are invested in a small private company. We're always hoping the shares go up faster than other shares. You know, we're like, hey, look at that. That's really great.
I just honestly, I hope I just get all my money back.
Return of your capital, not return on your capital.
No, I think I'll get return of my capital.
I think you will. But we all need to stop hoping for a lottery-like return. Mm-hmm. It's in our nature. I get it, people. And part two of that is we all got to stop being jealous of other people's returns. I run into this all the time. Hey, my neighbor told me. That's good for your neighbor, right? That's wonderful for him. It really is. It's great. You got to let that go because that just leads to trouble.
There's that guy who won the $2 billion lotto and is buying all those lots,
I know.
those burned lots in California.
Yeah, I read the piece.
How many people win the $2 billion lotto? Let's see. Let me count them. One.
Did you see what he ended up with, by the way, after taxes and everything, the one-time payout?
No, I didn't see the number.
It was somewhere in the high 700 million range. So
That's
it's
$2
not,
billion.
It doesn't end up
Gee.
being $2 billion. But
how many people have won that big a lotto, Tom? Let's try counting.
I don't know, but not very many.
No, wait, I know how many. Hold on. One. There we go.
That's it.
One.
And then just at the close for me, and thank you, Andrew Ross Sorkin, for writing this piece, which is wonderful, and I'm looking forward to the book because I'm not sure I completely understand the crash of 1929. You don't invest in things you don't need. We've talked about, I think the one greatest benefit, Don, that's come out of all the podcasts that we've done is you saying investing is mostly a process of elimination. Eliminate the things that you don't need, they're going to be trouble.
Don't too scary, too confusing, too expensive.
Yep.
If they have a 2 in front of their description, just chuck it.
Yeah. And if you can do that, if you can stay the course through whatever lies ahead and not deviate when you get all excited because you hear about these opportunities, you're probably going to be in a better place.
Probably. I think you will be. Can't guarantee it, but odds are good. All right, I think it's it's question time again. Tom do you have questions?
I do have questions in my
Do you still have a lot of them?
hands. Yeah, I've got quite a few. Yeah.
Okay,
I always try to hold back a few because I'm never sure what we might need on Saturdays, that kind of thing. So, but
Well, I just want to make sure you're getting plenty so I don't have to
but
beg.
we'll take more. We'll
Okay.
take more. We love them. And by the way,
Send 'em in.
sometimes I call people and just say, look, I can't answer this on the show because it's too much, but I'll talk to you about it. So, happy to do
Yeah,
that.
because sometimes, no offense, but sometimes you send like 3,000-word questions.
Well, it's not just the number of words.
It's all the
what you want to
securities.
know. People
Yeah.
often say, I'm getting this much Social Security. My wife's going to get this. Da, 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 da. Are we going to be okay? It's like, do you really want somebody to just do that off the back of an envelope? I mean, this is your retirement. Is that really what you want to do? Maybe not. So you might want to get more specifics. But this one comes from David in Kenmore, Washington. Listen to ETF Showdown. That was one of our podcasts recently.
That was one of our podcasts.
And it appears VT, Vanguard Total Global Fund, would be good for a simple 2-part plan, with the second part being bonds. I think we've suggested many times, this is my words, VT and BND could put a percentage in VT and a percentage in the bonds. What about breaking VT into 2 ETFs, perhaps VTI and VXUS, or ITOT and IXUS? Which 2 ETFs would you suggest over a single VT ETF? For bonds, I was thinking BND. Please advise if you have a better suggestion. In other words,
Well, I mean,
you
could
divide
use
it?
you could use VTI, which is the Vanguard Total US, and then which makes no sense with that I in there, or VXUS, which is the Vanguard Total International Stock ETF. You could mix those, but that requires another step along the way now.
And
when you
work as you go.
rebalance,
you got to rebalance it. As you go, you got to be doing the work.
Right. So you now have to do your international U.S. balancing act. And here's the thing we've found in our anecdotal conversations. You're going to tend to overweight the U.S. market.
It just happens. We just
You're
met
just
with
gonna-
somebody who was like, oh, I have a lot of international. No, you have 23%. That's not a lot in international.
Well, it is for me because I'm an American.
Yeah, I get
Where
it.
at least I know I'm free.
Yep. Good luck with
And
that.
I can overinvest in America because those other guys aren't doing as well. Well, they are now.
My question to David is why?
Yeah.
Why would you want to, if you're going to make your portfolio simple and you're going to use 2 funds, then why do you want to make it a little harder and make it 3? There's no advantage
there
other
is.
than, as you said, overweighting one side or the other.
Exactly. And see, here's my beef is I think the indexes reflect the current state of allocations in the global economy. And I believe that because of the big increase in the U.S. market over the past 20 years, that the U.S. weighting is a little bit too high. I think there's a bit of a contrarian in me that says, remember 20 years ago it was 50-50. 50% international, 50% U.S. Now it's 70-something or 60-some odd, 30-something.
Yep, 67, something in that area.
I mean, that's the only advantage, is that you can overweight VXUS. I wouldn't overweight VTI, but I might overweight VXUS.
Yeah. And this year, you've seen the internationals do better than the U.S. market.
Making me
you've
look
seen
brilliant.
the U.S. dollar fall dramatically, which has an impact on all of this as well. So, again, to me, it's a matter of how much work you want to do, and if there's some specific reason that you really want to have 2 stock ETFs rather than 1. But if you're trying to make it simple, I'd just do the 1. From Fairfax, Virginia, Dustin writes us, "Hi, Don and Tom, love the show. I have some individual stocks in my brokerage account that I obtained via an ESPP that make up 12% of my brokerage account and 2% of my overall portfolio. My stock is from a previous employer. Should I sell the stock to rebalance or just keep the stock? What considerations other than capital gains tax should I be considering? I'm not an individual stock picker, aligning myself to a diversified investment portfolio and concerned about tax implications. Keep or sell the 2% of your overall portfolio that's in one stock."
Sell.
Just
So I
clean
have
it
to
up.
say keep or sell. 1, clean it up. 2, it's still too much in one company. 3, you made money. What is with us and our serious revulsion for giving what we're supposed to give when we make money, which is that little 20% capital gain? I mean, that's the top rate. That's it.
And if you have no income up to, $94,000, you pay nothing.
The rate is 0.
Yeah, I mean, so ways around all of this. So, so maybe you could do some.
I'd definitely start selling. Now, maybe
you
there's
could do
no
some
hurry.
this year, some next year.
Spread it
Clean
over a
up.
couple of years. You do a little tax planning, but don't just cut off your nose to spite your tax face, your profit
And
nose.
the other question I would have to Dustin is the 2% in that one stock. Why do you believe that that's going to do any better than a diversified portfolio anyway?
Because that was my company.
Oh, okay. Yeah,
I know them better.
okay.
Like
yeah.
all those people who worked at Enron and had almost
gonna
all
say.
of their retirement money invested in Enron when it went bankrupt.
Yep,
Do you realize they didn't know it, and yet they worked there?
They didn't give them advance, unless you were Scott Schilling, they didn't give them a whole
Lay.
lot of advance warning.
Yeah.
So, yeah, I would go ahead and clean up the portfolio. And by the way, here's another idea. I don't know how old you are. I don't know your circumstance. If you really just want to unload it, you could give it away charitably. Charities
And
love
you
that
get
kind
the
of thing.
deduction
Yep.
for the higher value.
That's right.
But you
Yep.
don't pay the tax on the
Exactly.
appreciation.
So, I'm not telling you to give your money away, but that's an idea. You could do it.
If you're at the point in life where you're going, it's time to figure out what I'm going to do with some of my assets, and I'm going to give some to charity. That way, you can do it now, get the deduction now, not do it after you're dead. It's kind of an advantage.
Yeah, and people are generally willing to take it. I just saw my son yesterday, and I said, "Here, I'm doing some financial planning." He said, "Just make sure to leave me the money. It's all good."
Okay,
From there. So I said,
is he a 501c3 now?
he probably, knowing him, he's probably working
probably
on
is.
it. Yeah, that's one of the things he's doing. Great question. Send us more at Talking Real Money.
The Colombian Mothers Relief Fund.
Yeah, he's headed there soon too. So we'll see how all that goes. Good luck.
Wait a minute. You just go to good luck, and that's it?
Good luck
You
and
just
good night,
stop
or good night,
there?
good luck, whatever it was.
Are you ending the show like that?
No, I'm ending the show like this. Please keep sending us your questions. Please keep calling and asking for help, or go online and fill out the form there. So any of those places.
I'm trying
we
now
love
to
to help.
decide if I'm going to have to edit that, or if I'm just going to maybe I'll just put a little musical interlude in there. Just
And
for
then
a second, just like
I love that.
Tom stepped
Okay.
away from the mic. Here's your musical interlude.
Finally, he shut up for a second. So there's your opportunity.
I don't think we've done music in the middle of the show.
No, that would be something new.
I'm just giving us a moment for another one.
Waiting. So that's the cue for you to say something.
It is?
That was the. We don't have enough music for all this.
I'm just having too much fun with the music. All right. I guess we better put it to bed right now. And tell you that you can send us questions at talkingrealmoney.com. You can meet with one of our advisors by clicking on Meet an Advisor at talkingrealmoney.com. You can tell a friend by telling a friend about talkingrealmoney.com. You can leave reviews on Apple Podcasts, but don't do those 1 stars just because you disagree with us. If you disagree with us, you're listening, at least give us 3 stars. I mean, really, think about it. You disagree, but you still like what you hear. And let's see, what else? That's it. Let's let the girl in the music speak now about talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.